Right now I do have the absolute pleasure of introducing from all the way from Washington, D.C., J.P. Delmore, who is the Assistant Vice President of Government Affairs for the National Association of Home Builders. He's here to talk to us a little bit about opportunity zones.
Good afternoon, everyone. It's a pleasure to be here. It's always great to get out of D.C., especially as I'm almost as far out as I can be and still be in the continental U.S. I like that. I am excited to talk about opportunity zones. I hope you are too, because we're going to dive in pretty deep on exactly how these things work. I want to give you guys a sense, if you've been looking at these and trying to figure out, can I use them? Perhaps you own land in an opportunity zone. What does that mean for that land? I want to be able to answer some of those questions for you. If you haven't heard of opportunity zones, they are, very quickly, simply put, it's a tax incentive for putting in economic development into a specific geographic area. It's fairly straightforward and simplistic on that front, but as you see as we go through it, there's a lot to it. And a lot to think about, and including some timing issues that you want to keep in mind as well. So let's get into it. This is my usual don't sue me paperwork here. Not that I'm worth it, but and I do believe that everything you're going to see is very accurate, but when we deal with tax stuff, I have to put up some disclosures. We always recommend that ultimately you talk to a tax or investment advisor before you take any specific action. So this is how I'm going to break down this fairly complicated topic. What I want to start with is telling you where these geographic zones are actually physically located. Then we're going to move into how to actually structure an investment within an opportunity zone. And then I will finish by walking through what the actual tax benefits are from the investor perspective. So for the starting point of where these things are, that's been determined. It's fixed, it's done. There was a process that was completed about this time last year. All of the governors submitted specific census tracts that they wanted designated as an opportunity zones. The Treasury Department stamped those as approved, and we now have a final list. Nationally, there's 8,700 opportunity zones, actually over 8,700. 879 of those are in the state of California. So there's a ton of these zones spread out throughout the state. An important note, there is no process to amend or change these geographic areas. So for the next 9 years, these are what you have. You can't change them, which is helpful in terms of having some stability of knowing where they are. If you want to actually see where these things are located, I highly recommend that you only go to the Department of Treasury's website, which has the official list as far as the federal government is concerned, which is this department within Treasury known as the Community Development Financial Institutions Fund. So that is the place to go. I say with irony as I get into the couple of maps that I have here, these are not from the Treasury Department's website because they do not make it possible for me to download a map. This is a private mapping service, so just keep that in mind that they might be off just a little bit, but actually I think they're reasonably accurate and good enough to give us an idea of where these are located. So I'm starting with where we are here. I think I even have a laser. Ooh, look at that. Very high tech here. So this is where we are standing right now. Victorville is down here. This would be 15, I believe, so heading towards Las Vegas. You have, what is this, Apple Valley. I feel like a weatherman who doesn't quite know the areas. I'm pointing these things out. 395, wherever that goes, is this one right here. Sure, goes someplace very exciting. Maybe I'll find out this afternoon. This is Palmdale Road down here. And this border here is the actual Mojave River. So that gives you a sense of where we are directionally. You can see the airport stands up pretty clearly there. So you can see there's a huge chunk of this area that's an opportunity zone, which is great. And then this is, if you shift more to the other side of the mountains, you have a whole host of additional opportunity zones. I just want to get you a sense of exactly how many these are. Some of them are quite small, some of them are combinations of different census tracts, so you have a bigger area. I should give this side some love. If I can point over there, San Bernardino is over there. Most of that is an opportunity zone. What else do we have on here? Riverside, most of that is an opportunity zone. That is Ontario Airport, where I flew in yesterday. So you can see them, but really we're all over the place. And I want to make 2 points about this. First is, regardless of what your business structure is, whether you're an investor or a developer looking at this, there's an opportunity zone somewhere geographically that fits the type of investment you're looking for, which is great. There's a lot of these things, so that's great. Secondly, there's a lot of these things. There's 879 in the state of California. So if you're looking at this from a public policy perspective, if you're looking at it from a local elected official perspective, what is going to bring the investor into your community? It's not something that most communities are thinking about. A lot of places, there's a lot of hype about these things, and people have this vision, if you designate it, they will build. It's not a Kevin Costner movie. You're going to have to do more than that in most places. I don't have the map, but if I showed you downtown LA, it's ringed by opportunity zones. So where is the money going to flow? Downtown LA, or is it going to flow out here? The question is what can you do to make a difference, to make this a more attractive investment opportunity than some of the areas where your investor base is going to be a little bit more familiar? So I would encourage, particularly from the elected official side, to pay attention to the investor tax benefits and then put yourself in their shoes to figure out how they're looking at these 879 different areas around the state. I think that's going to be really important. I think there's different things you can take from this panel and apply them to the opportunity zones. Expedited permitting, lowered fees, things like that, that make a difference in terms of the return to the investor that's going to bring them to your area. So it's not something I've seen a lot of in terms of folks actually starting to think about, what do I need to do to recruit people in there? How many investors know that all of this exists? That is some key questions. I don't have all the answers for that, but I know it's something to think about. So let's get into what all of this means in terms of how you actually take advantage of this new set of tools. So the law targets capital gains income, which is important. We'll talk more about that, but that's the only investment dollar that's allowed. So capital gains that you get from a sale of a stock or from property, whatever it is, if it's a capital gain, you can invest it into these. What's called a qualified opportunity fund. A QOF. I'll use that term quite a bit. There's a lot of these weird terms, and they all tend to have the word qualified and opportunity in them. I'm going to use them because that is, if you're using this program, you need to be aware of what the terminology is. But I want to peel back the sort of DC speak on this. A qualified opportunity fund is something you guys are all familiar with. It's simply a business. It's actually a corporation or a partnership. And it has this fancy term, qualified opportunity fund. You create it like you do any other corporation or partnership, and then the money in there is invested into whatever your ultimate investment is. So it's actually quite easy to establish one of these funds. So from a business perspective, if you're a developer, you might be able to tap into this marketplace as a new source of equity. And if you're an investor, there's obviously very specific tax benefits. And if you're in a very fortunate position, you might be able to combine the two. You might have your own source of investment dollars, your own capital gains. Let's say you have a multifamily building. Instead of doing a 1031 like-kind exchange, you might want to realize those capital gains and invest them in your next project in an opportunity zone. Do the double dip, be the developer and the investor. That would certainly have a lot of upside potential. As we move deeper into this, I'm going to very intentionally talk about issues of this program that are based upon the current draft regulations that came out in October and issues that are part of the statutory requirements. And the reason is those draft regulations are in draft form. They haven't been finalized. So it's possible that some of this could change when the final regulations come out. Versus the statutory requirements, those are fixed, those are unlikely to change. I do anticipate in the next couple of weeks the next round of draft guidance to come out. The first round, fortunately for us, was much more real estate focused, so it answered a lot of key questions we have. The next round is going to focus on operating a business within an opportunity zones, and there's also a need to clarify issues related to non-compliance. So if you have an investment and it turns out not to be in compliance, how is that meant to be handled? So those should be out, they're saying in the next 2 or 3 weeks. We'll see. When I get to the end, I have a website on NAHB's webpage just for opportunity zones that I've created. So when the next wave of guidance comes out, I will be posting information on that, and it's a resource you can go to and access and read about exactly what the IRS is up to. So to understand how these things work, we start with the Qualified Opportunity Fund. I like to think of this as the mothership. Everything emanates from the QOF. And as I said, the QOF is just a business entity, partnership or a corporation. So it's something you're probably very familiar with. And what we're doing here, simply put, is starting a business, the QOF, that will then invest in other businesses or in investment opportunities from there. And the IRS has said they want to make this simple, which is not something you hear from the IRS a lot. But actually, in this case, I think so far they did meet it. We have years ahead of us for them to complicate it, though. But right now, it's a fairly simple process. So the idea is anyone should be able to create a QOF. They want to make it simple so that it's not just a Wall Street vehicle, so that folks from the community can create their own investment fund and reinvest back into their community. But if you want to create one of these things, all you have to do is create an entity or take an existing entity, that's a corporation or partnership, fill out IRS Form 8996, which I even labeled down here. You're fill that out the first time, and you fill that out as part of your annual compliance requirements. Now the good news is this form is out in draft form, so you can take a look at it and see what the general requirements are. It's actually a fairly short form. The bad news is it's in draft form. So there's potential for some things to change. But I think in general, there's enough comfort level with where the IRS is that we already see people who have established QOFs. The form would need to be filed for next year's tax filing is how I understand the IRS will ultimately do it. So you can create the QOF now and then do the filing down the road once they finalize this thing, which hopefully will be when they finalize the first wave of regulations that came out in October. So this is the mothership, the QOF, and the QOF can then invest in 2 different ways, and we're going to talk about each of these. One is the QOF can directly own the asset, and the other is the QOF can indirectly own the eligible asset. But before we do that, a few things that you cannot invest in. If you do new markets tax credits, you know this list because it's the exact same list of things you cannot use new markets tax credits for. It's also a really old list. So I did this presentation in LA, and the first question I got was about a marijuana grow dispensary. I'm like, well, it's not on the list, so you're good to go. They might want to update the list if that's what they want to do. Anyway, so golf courses, country clubs, the liquor stores, you can't generally do these. There is a way around this, but if you want to know how to get around it, find me afterward and I'll explain it to you. So, that's what you cannot do. Let's start with the QOF. Again, our mothership is making the most simplistic type of investment form under this new law, which is the QOF directly owns the asset. So think of this as a partnership that directly owns a building. The statute has a requirement of this 90% test. What that means is 90% of the investment dollars in the QOF have to actually go into an investment located in an opportunity zone. The other 10% could either remain as cash reserves, or you could invest in things outside of an opportunity zone as well, as long as you keep that 90% ratio throughout the period of ownership. One of the key things, actually, part of this is the investment isn't just real property, it's actually tangible property. So you can invest in more than just real estate and have that being a qualified investment. An example I might use is a bakery that buys a new building and then buys ovens for that building. All of that can qualify as long as it's located within a geographic opportunity zone, both the ovens and the building, all tangible property. Generally, the rule is if it's physically located in the opportunity zone, you're okay. There is a question about delivery vehicles that needs to be answered when they leave the opportunity zone, but I don't think the IRS should be able to figure that out. So this is the most simplistic approach. I don't see this being the most commonly used approach, in part because the QOF has to have enough money to completely purchase and buy and own the asset. And many QOFs that are being established are also looking to make multiple investments. So the second approach is more common. But let's say you're a multifamily developer and you're doing that the example that I used earlier. Instead of doing a 1031 like-kind exchange, you're going to buy a new building using those capital gains and take advantage of this. You might want to use this type of structure just because it's fairly straightforward to do a single deal. This gets a little more complicated here. Don't be too alarmed. We will explain and make sense of this, and you'll see some additional opportunities. This is what I think most investments, how they'll be structured. And so the difference between this and the first example is the QOF is not directly owning the investment. Instead, the QOF is investing into another business. So this is one business investing into a second business. The second business is called a qualified opportunity zone business. Told you they use these qualified opportunity in everything in this statute. The qualified opportunity zone business has to be located in the opportunity zone. The QOF, for example, could be a structure, a partnership, the qualified opportunity zone business could be a partnership that owns a building, and then the QOF is a partial investor in that project. And the QOF can hold partnership interest, the QOF can hold stock. It's a very typical arrangement, I suspect, to many of you in terms of how these deals are structured. The advantage of this is it allows the investor, the qualified opportunity fund, to invest in multiple investments or to be a partial owner in an investment. So they may own 10, 15, 20, 80%, whatever they want of the qualified opportunity zone business, whatever makes sense from that standpoint. But there's some rules, important rules of when you're structuring an investment like this. The first is that same 90% test that I had on the other slide, that applies for the investment between the qualified opportunity fund and the qualified opportunity zone business. So 90% of the assets have to go into the business. But there is a requirement in the statute that says to be a qualified opportunity zone business, 70% of your assets have to be within an opportunity zone. Actually, apologies, let me take that back. It actually says, the statute says, substantially all of the business has to be in an opportunity zones. The IRS has said that substantially all in its regulation means 70%. This is important because this 70% number could change because it is strictly in the draft regulations, and actually the IRS has asked whether that number is appropriate and should be adjusted upwards. And let me explain why they might adjust it upwards. So just follow the money with me for a second. We're going to put $1 million into the qualified opportunity fund. That's the investment dollars. Now the statute requires that 90% of that, or $900,000, goes from the qualified opportunity fund into the qualified opportunity zone business. Right? Got me so far. So now the statute says that substantially all, which the IRS is saying is 70% of that money has to go into the opportunity zone investment. Now we're talking 70% of $900,000. So $630,000 of that initial $1 million investment ultimately has to end up in a qualified opportunity zone, the actual physical geographic area. But if you think about it, wasn't $1 million supposed to go in the opportunity zone? In theory, yes. In practice, the policy intends that way. But the reality is the way the IRS regulations are, you can actually have 1/3 of your investment be in something that's not in an opportunity zone. So if you're an investor, you're probably going to exploit that a little bit. You might try to buy into a whole bunch of different buildings and have some of them be in an opportunity zone and have some of them be out of an opportunity zone. But the one thing I do want to mention is the IRS has said maybe that substantially all definition should be 90%. Now that still doesn't get all of the money into the opportunity zone, but instead of 63%, you have 81%. So these balancing issues are something to be a little bit cautious about until we've had the final regulations. What I do anticipate is that rather than people gaming the system, in most cases it's going to be cash that's being held for various issues rather than investments that are partially in and partially out of an opportunity zone. So as we get into some of the development challenges, this is one of a couple that I want to point out. It's called the substantial improvement requirement. This applies if your investment is an existing developed parcel of land. So if it's already been improved at some point in its lifespan. The statute says that for the investment to qualify, you have to substantially improve it, which they define in the law as doubling the basis of the acquisition price. Now, the IRS regulations has done something very helpful in easing the burden of that doubling the basis. And they have said in the regulations and in a revenue ruling that the value of the land is excluded from that doubling of the basis. That's really helpful, particularly in an area here where land is ultimately oftentimes the most expensive component in a deal. But if you're trying to do affordable housing, particularly really targeting folks below the area median income, this is going to be in some cases a really big burden. Because you're going to have to put in a minimum investment dollar. So I think about an older apartment building that needs to be fixed up and rehabbed and put back in service. You're going to have to put in a certain amount of dollars to qualify for the substantial improvement test. That could price out those folks who are looking to be served by that marketplace. Same effect actually in the market rate world too. You have to be very careful of what your minimum investment requirements are within the substantial improvement test. So the other issue is one that actually fits in a lot with the previous panel discussion, which is some timing issues involved in meeting the requirements of the investment. When this was drafted, the lawmakers who put this together said you have 6 months to invest your money into the investment. That is clearly someone who has no idea how long it takes to do real estate development. Because you have to move the money from the QOF into the investment. And as you guys know, you're not going to have that ready or even close to ready in 6 months. But this is a key area, I think, particularly from the policymaker perspective. If in your area, the developer cannot meet the time requirements, the investors are not going to come into your area. So this is what the time requirements are. The IRS has done, I don't say this very often, a fantastic job at making this, at times, poorly written piece of legislation into a workable investment tool. And one of the things that they've really fixed from the Congress who wrote this is the capital safe harbor is added as part of these draft regulations. And what this says is that you actually get up to 31 months to make your investment. So the dollar goes into the QOF. The QOF has 31 months to put that dollar into something tangible, as long as you follow a couple of simplistic issues. One is you have to have a written plan for how that money is going to be spent. You have to have a written schedule, and you have to substantially comply with that schedule. And as long as you do that, you can keep the money in the QOF and earmark it for acquisition, construction, or substantial improvement. So this is a huge improvement from the 6 months test. If they didn't do this, this would be an unworkable program for us. Now, I'm not saying it's perfect. In fact, our comments back to the IRS, the one thing I said to the IRS is, what does substantial compliance mean? What happens if you hit a roadblock that you didn't anticipate? So that's the key thing, and I hope when they finalize the regulations that they do elaborate on what that means. I actually asked them to say you're in compliance if you incur unexpected delays, which include permitting delays. But 31 months is still what you have to do. So from a governmental perspective, they have to be able to meet this time frame or the investment is worthless. There are related party rules, something to study up if that's an issue. It involves more of if you own land, selling it to yourself for a QOF, you generally can't do that. Let's get into the tax incentive side now that we've looked at more or less the development side. As I mentioned at the beginning, the only investment dollar is a capital gains. That is a limiting factor here. So you either have to have your own or chase an investor who has capital gains money that they're looking to invest. When the capital gain is realized, you have 180 days to invest that money into the Qualified Opportunity Fund. And there are some very specific tax benefits from doing this, actually some extremely generous tax benefits. So even if you're the developer, you're going to want to know what the investor is looking for to understand how to structure your developments in a way that works for the investor. But there are two sets of tax benefits for the investor. The first involve that money that's invested in the Qualified Opportunity Fund, the capital gains dollar. The first benefit is you don't have to pay taxes when you realize the capital gains on any money that you put in a QOF. So all the QOF investments are pre-tax, if you will. And then after 5 years, that money invested gets a 10% basis adjustment, which means that you only pay taxes on 90% of the invested dollar. You get a tax break right there. After 7 years of holding the investment, you get another 5% basis adjustment. That simply means if you put $100 of capital gains, after 7 years, you only have to pay taxes on $85 of the 100. So that is already a pretty significant tax break just on the investment side of things. You can already see that this is structured towards long-term investments. Now, after 7 years, there's no additional investment incentives on the money invested into the fund. But there is one more very significant upside for the investor, which is if you hold the asset for 10 years. If you do it for 10 years, when you sell that asset that you invested in, you don't pay any capital gains taxes. So that's pretty significant. So you can see if you structure a deal in the right way, you can make a lot of money in this. The one thing I should point out, if you haven't gotten it at this point, is this does require a long-term investment strategy. It requires holding the investment. So at this point, it does not work for the single-family for-sale marketplace because you're not holding that single-family home if you're selling it. If you are in the single-family space and want to take advantage of this, you're going to have to create a slightly different business model, one where you might be looking at rental of that single-family home, or even a rent-to-buy scenario where you're maintaining ownership of that single-family home for that 5, 7, or 10-year period, whatever the investor is demanding, so that there's a capital gains upside on the back end. For the multifamily and the rental market, this is a no-brainer. It's a slam dunk if you can find the right investment. Because you're going to retain that, you're going to go in, you're going to hold that asset for a number of period of time. You might not hold them this long. This will certainly change how you do that, but there's a lot of money to be made. So this is my very simplistic example of how this tax incentive breaks down in terms of sort of real dollars and cents. I use, this is based on a 5% rate of return over a 10-year period, and I have the same $100 capital gains. So this person sold stock, they got $100 in capital gains, and in the QOF column here, they're investing in the opportunity zones, and then in the other column over here, this is a regular investment back into the stock market. So you can see the first biggest benefit is actually one that's often overlooked, which is the QOF investment is pre-tax. So if you're investing back into the stock market, you have to pay your capital gains tax on that $100. So you lose 24 bucks of it, because I'm assuming they're paying at the 23.8% rate. Yes, I did rounds for simplicity. So you lose 24 bucks of it while you start off already $24 ahead in the QOF. And then after 10 years, you have in the QOF at 5% $163. But in the regular investment, you only have $124. Again, that's because of that pre-tax ability to invest in QOF. Now, after 10 years, or 7 years rather, the QOF investment dollar only has to pay taxes on 85 of that $100. So that saves them 20 bucks right there. And on the regular investment side, they've already paid their taxes, so they're done with that. But if you look at just the bottom line difference, the $63 in appreciation of the initial investment after 10 years, right down here, that is tax-free after 10 years. So when they sell that, they don't owe anything on the 63 bucks. While the regular investment, they've only made $48, but they also have to pay capital gains tax on that, so that's another 11 bucks. So the differential, as you can see at the end, is $30. Not a lot of money, but we're not talking most of these investments of being just $100. They're a little bit larger than that, and you can see just in a 10-year period, that's a really significant difference on the rate of return. Now, as we roll into the end of this, thank you, you've made it this far, we're almost done, is some of the pesky details. Now, I have to say, I don't write these things. If I did, I would do it quite a bit differently. But this is where things go off the rails a little bit. And we're involved in Congress, so do I even have to say that everything's off the rails, right? So this entire statute expires after 2026. And that means when you file your 2027 taxes, the investment dollars where you deferred your capital gains taxes, you actually have to pay your capital gains taxes if they're still being invested in QOF. It also means after 2026, no additional money can be invested in a qualified opportunity fund. Technically, the cutoff is halfway through 2027, because if you realize capital gains on December 31st, 2026, you have 180 days to move that into a qualified opportunity fund. But after that, the investments are over with. And in addition to that, the designation of an opportunity zone expires after 10 years, which the clock started on that last year. So they actually expire 9 years from that. One of the things the IRS has done, again, they did actually a terrific job with these draft regulations on the whole, is clarify two issues. One is, when the opportunity zones expire after 10 years, your investment can remain active and you can continue to accrue to that 10-year investment mark of having the capital gains on the investment itself waived. The other thing they said is you might not want to sell the investment right at the 10-year mark. So we're going to give you 20 additional years before you have to sell the investment. Specifically saying, if the market conditions aren't right in 10 years, don't worry about it. You got 20 years to figure out when the market conditions are right, and then you can sell your investment, and you still get those tax benefits. So I really think that the IRS bent over backwards in terms of making this try to be as effective and useful as possible. So just to put this in a more simplistic word, what do these deadlines mean for the investor? To get the 5-year benefits on the investment, the capital gains invested, you need to make that investment before 2022. To hit the 7 years, it's got to be this year. It's got to be this year. And then to hit the 10-year mark, you actually have until mid-2027. And then again, you have until 2047 to sell the asset. And then your other option, if you want to, I'm taking money on this bet, Congress making this permanent. You can also bet on that. But right now, I would pay a lot of close attention to these investment deadlines. So what you see right now is investors are scrambling to get their money in the ground this year. I will mention this. So that I can't give you tax advice, I can't give you investment advice, but there is a list of qualified opportunity funds that a trade association that we work with a lot, I don't know, they must have a staff who spends a lot of time sorting through all these things. They've now identified more than 100 qualified opportunity funds whose assets range from $1 million to $3 billion. It's a total of $24 billion sitting in these funds. And these are only funds that are multi-investment funds. In other words, we're not looking to raise money specifically for one project, but for multiple projects. $24 billion sits out there. That's a lot of money for us to tap into. Now, I can't vouch for any of these, but you can certainly take a look at. This is the website I mentioned. The coloring doesn't look so great there, but it says nehb.org/OZ. A link to that list is on the website. I do keep this up to date. It's sort of my little child. When new regs come out or have more information, I have an FAQ on there. I have a lot of this information is up there. So, it's another disclaimer as well, but hopefully that gives you a bit of a sense for what these things are, how to use them, some of the pitfalls. But I think if you can figure it out, there is a ton of money to be made utilizing this tax tool, and I hope you can take advantage of it. Thank you.